All right. Well, welcome everyone. Thank you so much for joining us today for our FinTech Committee's, I believe this is our sixth roundtable/webinar. And today's discussion is on insuring digital assets. So commercial liability, D&O and cyber insurance have become table stakes for most companies today, especially for high growth tech companies that are becoming major pillars of Canada's economy. For most of these companies, acquiring adequate operating insurance coverage is pretty straightforward. Unfortunately, this is not the case for blockchain and crypto asset businesses, especially if you take custody of those assets. At this time, there's strong institutional and regulatory demand for insurance in this sector. However, like banking, the coverage that is available to companies that deal with blockchain technology is very difficult to obtain, and once obtained, it's often inadequate and can be cost prohibitive, especially when required to insure customer assets that are held in cold storage and warm and hot wallets. While industry standards are starting to emerge, there has been variability even among the more regulated exchanges and custodians. This has led to some creative solutions that range from bespoke policies offered by traditional insurers like Lloyd's of London to self-insurance solutions employed by Binance and BitGo to a captive structure created by Gemini in Bermuda to on-chain insurance products like Risk Harbour. With the accelerating adoption of crypto assets across the world, it is clear that adequate insurance and risk mitigation solutions are required if this industry is to safely play a prominent role in Canada's economic future. The Canadian Blockchain Consortium's FinTech Committee is very excited to present this panel of experts from the insurance and digital asset sector to discuss the challenges and opportunities. So again, thank you so much for joining with us here today. Our Canadian Blockchain Consortium, just a little bit about us. We have been around since 2017 now. We are currently the largest and most active industry association in Canada, boasting about 70 members now. We're very excited about. We put a lot of emphasis into our advocacy work, helping educate our governments. We do a lot towards education. We build a lot of the academic programming for major academic institutions. We do research white papers. We have 9 very active committees, and we put on a lot of great events and webinars like you're attending today. I just wanted to give a big shout out. Thank you so much to a lot of the members that you see on the screen today. As a not-for-profit and mostly volunteer-based organization, we couldn't do it without all these amazing companies helping us move forward. One of the things we are excited about, we have spent the last 2 years putting together a magazine every single month. So if you'd like to get up to date on the latest news that's happening in the blockchain space in Canada, it's a great resource. Check it out at canadablockchain.ca. And without further ado, I'm going to hand it over to our amazing moderator, Mark Morency. He's a Senior Vice President and Financial Institutions Practice Leader in Canada for Gallagher Canada. And I'll let him introduce all the amazing panelists that you'll have today.
Thank you. Sorry about that. Just my first challenge on the webinar. As soon as I was about to unmute myself, the screen moved. So, well, thank you for having me. I'm excited to facilitate this session. We've brought together a great gathering of both the insurance industry that does look at the blockchain space and leaders in the Canadian blockchain cryptocurrency industry. So, you know, we're sort of well balanced. There's 3 of us on each side of the table, so we can really, you know, feel free to not withhold any punches. I thought maybe, well, first of all, thank you for introducing me. You know, as you mentioned, I'm a financial institution practice leader for Canada. Gallagher is a global brokerage, and we provide digital asset coverage, where we have been very active in this space and work with the insurers that are on this panel. I thought maybe I would let everyone introduce themselves, a very quick introduction to who you are and why you have an interest in insuring digital assets. So I'll go sort of counter or clockwise around the way I see you on the screen. You probably, you know, the rest of you probably don't see us in the same order. But why don't I start with Raymond?
Oh, thanks, Mark. Thank you for the opportunity to join the panel today and speak with everyone. I'm Raymond Zenkich, president and co-founder of Evertas. We were founded back in 2017 with an exclusive focus on building out insurance infrastructure for the crypto asset industry, obviously relevant today. That touches on custodians, exchanges, funds, corporate treasuries, family offices. Today, we provide policies that insure against theft or loss of digital assets. We're institution focused, as I mentioned, and we work through brokers like Mark, wholesalers, to really help insurers with their crypto-related coverages. Our team is a bunch of crypto natives, includes people who've built out internal blockchain teams at global custodians, developed and implemented custody systems, so very technical, and even led investigation teams, so we know how to do the forensics to support claims activity. We really focused day one on building a world-leading underwriting capability and claims to bring more capacity to the market. That's one of the things I want to talk about today. And in addition to being a Lloyd's cover holder with authority in Canada and elsewhere globally, that's an A+ rated paper. We have a Class 3A license in Bermuda for crypto asset insurer, and look forward to the discussion.
Great. George, you're next on my screen at least.
Hey, Mark. Hey, everyone. Thank you for having me here. I'm George. I'm Romanian by origin and slightly upset this morning that we weren't accepted in the Schengen zone. But frustrations aside, I'm the co-founder CEO of Balance. You can find us on balance.ca, and we're one of the oldest and largest custodians for digital assets in Canada. We started in 2017, went live in 2018 in a closed pilot, did a broader launch in 2019, and since then, although we can't serve dealers, advisors, and investment fund managers, we've nonetheless expanded the business across a wide variety of verticals, from trading and exchange platforms to lenders, ATM networks, foundation treasuries. And these days, we're at the current market prices, we're hovering around 752 billion worth of assets in custody, depending on the day and depending on where the market is. As you can imagine, insurance is a cornerstone of our business. It's something that clients ask for from the very get-go, from the first discovery call that we have with them. And over the years, we've been maintaining coverage, all sorts of types of coverage, both for their peace of mind and ours.
I don't know if Paul is there. Paul was actually boarding a plane, I thought I heard. So, we can do business anywhere nowadays.
Yeah, hi, I'm here, Paul Burak. So I'm the compliance officer at Newton Crypto. We're a Canadian registered crypto asset trading platform, expanding in the US as well. Doing securities compliance, AML compliance, other compliance as well. 16 years of compliance experience across public and private sectors, and look forward to speaking about some of the challenges CTPs have with insurance and maybe some best practices going forward. Thanks for having me.
Thank you. And Joseph?
Yes. Hey, everybody. Joe Zilkowski, CEO and co-founder of Realm Insurance. Realm is domiciled in Bermuda. We obtained our license from the BMA back in 2019. We were the first regulated commercial insurance company to obtain an IIGB license, which allows us to transact insurance in both fiat and non-fiat currencies. We launched with a focus on providing support on an informed and dedicated basis to companies operating across the digital asset ecosystem. And since launch, we've now provided coverage to companies operating in more than 30 countries around the world. We've got nearly a dozen insurance products that serve companies operating in both centralized finance, decentralized finance, and supporting some of the largest traditional finance companies that are now making their inroads. So great to speak to everybody, and look forward to the discussion.
And then last but not least, Didier.
Thanks, Mark, and thanks to the CBC for hosting the panel and all the participants. So my name is Didier Lavallée. I'm the CEO of Tetra Trust Company. Tetra is Canada's first and still only fully qualified digital asset custodian. We were founded in 2019 and received our license to operate in 2021. So Tetra provides custody for accredited institutions in Canada, specifically funds that either fall under National Instrument 31103 or 81102, as well as family offices. Why do we care about insurance? I mean, George does a great job explaining why it's important from a custodial standpoint. I would say it's even more important when your clients are regulated. A lot of them have requirements in terms of, insurance insurability. So we need to comply with all of that. So excited about the panel, and thanks for the opportunity.
Well, thank you, everyone. So, and the timing of this is interesting. It's, cryptocurrency has been in the news quite a bit for the last little while. So why don't we start, we'll jump right in with the elephant in the room. It's been what, about a month, not even a month since the implosion of FTX. The complex fail, the fallout from it, fallout that may impact other players in the market. So I'll ask Joseph to start with this question. How do you think this is going to impact the insurance sector?
Sorry, I was on mute. Yeah, I mean, I think it's absolutely it already has had an impact on the sector, right? I mean, there's direct fallout arising from, the FTX now made insolvencies, and then there's the indirect fallout from those companies that were interacting with either of those entities on a counterparty basis, either as an investor on their cap table or as a significant custodian for their fund or company assets. And I think that the challenges, I think are some of which I think are obvious, but I think from the standpoint of insurance, it's really forcing a lot of the existing capacity providers in the space and those that are anticipating deploying capacity in 2023 to understand how a company as prevalent as FTX could have found itself into insolvency. And I think it's now becoming clear that things like governance, risk, and compliance cannot be overlooked. The competency and credibility of management teams, the importance of board engagement, transparency and regulatory clarity, importance of detailed financial reporting. So I think it's going to be the impetus for rapid maturity within an industry that's grown at an amazing pace, has evolved quickly over time, but certainly those core kind of fundamental foundational components that give companies resiliency and longevity, I think have been lagging behind innovation. So from our standpoint, as we came out on our website, we actually provided insurance to FTX US and FTX Australia. We've also provided coverage to some of the companies who are operating businesses in the digital asset space who have had losses or have funds locked up on exchange. And for us, obviously it's a tough time for the industry, but this is really an opportunity for Realm as an insurance company to uphold its other end of the obligation other than collecting premium, which is to provide as much support to our policyholders as we can based on the policies that we've issued.
Sure. Anyone else want to add to that, or is FTX kind of a done and the industry is going to move on? Or
I guess
if I could add a couple of. Sorry, go ahead, George.
I'm just going to chime in quick. Something that's important to realize, I'm not entirely sure whether FTX, the international business, had any sort of insurance coverage or what representations they gave about insurance in their terms of service and to their end users. Not that it would matter much given all sorts of representations that are broken. But the important part to realize is, regardless of the type of coverage, usually the customer exclusions in these policies account for any sort of willful, intentional act done by an insider, anyone that's a 10% plus shareholder, or any sort of activity that might be happening with the entity. For example, just taking customer deposits and trading them over on some venue for a profit. So in those particular cases, and more broadly, insurance isn't a hedging instrument for activities that are going to happen within the entity, nor is it meant to cover any sort of fraudulent activity. So.
Yeah, George, I mean, you make a good point. I think this is, but it's also, I think, a point of clarity that's sometimes lost from even people who currently purchase D&O insurance or who are considering purchasing D&O insurance. As we're watching this FTX situation play out, you have a handful of people that apparently had an idea of, the activities that are taking place that led to the company's insolvencies. And then you have a number of other executives, or maybe perhaps members of the board of some of the subsidiary companies who knew apparently nothing about the activities that gave rise to this insolvency. And what's interesting about D&O insurance is, while you're right, it does exclude coverage for acts of fraud. usually, and in almost all of the standard terms and conditions of a typical D&O policy, that conduct exclusion only excludes coverage upon final non-appealable judgment, right? So between the point at which a claim is filed and the point at which a final non-appealable judgment of some amount of fraudulent activity has been determined, D&O coverage really kind of serves independent compliant D&Os really the opportunity to have a source of financial recovery and funding for litigation defense expenses. So in that sense, ultimately, an insurance company who's issued D&O to some of these companies is going to be funding legal defense expenses. And only the point at which fraud is determined is that insurance company going to be able to kind of go down this approach of allocation and potentially be reimbursed for any litigation expenses it funded for those malicious acting Ds and Os.
Just a super quick question, and forgive me, Raymond, I'll make this 5 seconds. What happens in those cases though? So say in that sort of an event, like you've eroded through some legal costs, like in the policy, it's deemed at the very end that maybe it was fraudulent. Would you be able to recoup it, or is that a sunk cost for you by far and large? Because recoup it from whom?
Well, and it gets complicated, right? Because the fraudulent actions of a CEO or a CFO can't really be imputed on those directors who were not perpetuating acting as part of the fraud. So the challenge for an insurer is, number one, to reach a point of clarity on the judgment. And to the extent that there is a determination of fraud in some form or fashion or another, to pursue recovery and hope that the company that is now insolvent actually has the liquidity to reimburse you for those expenses that never should have been covered in the first. So from an insurer's standpoint, issuing D&O insurance for a company that's insolvent, kind of philosophy has to be that even if you feel strongly about the likelihood of a fraudulent outcome, you can't really rely on, source of recovery as part of your reserving strategy, like to maintain a conservative approach in that regard.
And maybe one of the catch-22s that we're dealing with this topic is that it is difficult for cryptocurrency companies to get coverage. At the same time, this kind of shows the importance of having D&O coverage, for example. A takeaway from this is having adequate coverage for your defense expenses, because regardless of guilt or not, defense is just as costly.
Yeah, those are all really good points. And Mark, I just want to maybe add a slightly different view on it, which is in terms of fallout. I mean, I think, in Canada, US, and worldwide, it's quite clear that there is regulatory fallout here, going to be evolving over time. But, crypto in general is under much greater scrutiny if it wasn't already. And, what we did last year is we actually responded to the SEC here in the US. They put a request out for comment regarding the custody of digital asset securities by special purpose broker dealers. And we actually took the time to think through how should regulators be thinking about regulation. And our view is, and this ties back to insurance, is, look, if you can have an objective third-party assessment of the risk, and also in the case of insurance, these are insurers who have a financial the impact of losses, this can help them play a key role in trying to provide that view into an entity. And so for us, our view is that an active and engaged insurance industry is really well suited to support solutions that move lockstep with a very quickly moving industry. George can tell you how fast these technologies are evolving, and to think that a regulator is going to stay on top of it is just, it's likely not going to happen. So you do need to think about, like we have, 20 categories of risk. We're updating it continually. It needs to be dynamic. And that, I think, is going to be the struggle, is how can the regulators support, third-party objective assessments by people who can keep up to date and in tune, and try and drive some of the protections they're gonna seek. I mean, the short answer from my perspective is there needs to be more insurance participation, not less. We see the way to get there and to get capacity providers in and comfortable is to provide that deep in-house knowledge of the risks themselves. And at the end of the day, there is a massive need, and we have to figure out how to fill it.
So does that mean, are you saying that insurers can play a role then in helping prevent something like this from happening again?
Well, it's not so much about prevention, I would say, as risk mitigation, right? So when we go through our underwriting, just look at an example of cybersecurity as a good analogy. You know, the types of questions that are getting asked and the requirements that are being made, that's really a result of experience of risk in the space and trying to, you know, incentivize the right behavior of insured. So, you know, it's really about risk mitigation and highlighting, as Joe mentioned, things around governance. You know, in some ways, it's many non-technical issues that need to be addressed and be insured or make sure are taking place.
Just to crack a joke here, Paul is expanding Newton into the US right now because his flight got moved, so it seems he had to drop.
Yeah.
No.
All right, I'm going to turn to the industry now. Maybe I'll start this question with George, although it is an insurance question. You know, we know that some digital asset exchanges, custodians, that do have third-party insurance. It's also you know, adequate and cost-effective insurance is somewhat difficult to come by. So what sort of coverage do you see that's available today? You know, I know that you are a well insured custodian. So, you know, what coverage do you see that's available out there? Is it adequate? And you know, how have things changed? How are you seeing it change over the last couple of years?
I guess, and very interestingly, so I had this conversation with a public company recently because we're trying to discuss what exactly would be a standard industry practice with regards to what a good insurance policy is for a custodian. The way we regard it, the economics of it just wouldn't make sense. You can't insure the assets in full that you have at a custodian, same way they can't insure your house in full or your car in full. Just the model doesn't make sense. So the way we look at it is the key driver is what is the ratio of assets that we have insured versus the ratio of total assets that we have in custody. We try to operate with a ratio around 1:75 or below. You know, from a regulatory standpoint, some informal guidance that you can find, for example, in IROX's rule book, Rule 4400 around custody, specifies that they expect the custodian of a securities dealer to insure at least 1% of the nominal amount of assets that they have in custody, so 1 to 100, right? In the crypto industry, more broadly speaking, at the peak of the bull market, those ratios that even large players such as Coinbase, Gemini, BitGo used to go into 1 to 200, 1 to 300. So now to get back to your question in terms of what we've seen, it has been extremely hard to get access to not necessarily the large underwriting pools, but the set of underwriters that are flexible enough to understand that we might have to dial up and down the amount of custody, the amount of insurance that we hold under the policy as the value of the assets under custody fluctuates with the market. The insurance policies, they remain denominated in fiat currency. So, you know, like if the assets that we have drop down to half of the value, I'm going to be covered for the same amount. Like I don't believe they can even have a good informed conversation about putting a Bitcoin denominated policy in place with most of the underwriters, not all of them. Coverage has been getting better ultimately, and to no one's surprise, like with some of Gallagher's help and some of Mark's help, eventually when you can get access to those large underwriting pools, you do, you know, like if you want to take it all the way there and say, we're going to package 500 million worth of insurance, assuming that you need it, like you can get that kind of access and that kind of capacity. The flexibility of the policies themselves again remains a big problem, and this is what I still see today. And I'll stop with it here. I know Mark has some interesting thoughts with regards to how some of those policies tend to go up and down. For example, when insuring some traditional commodities such as copper. So maybe there's something to be said about the digital asset industry. Like the underwriters that operate in the space taking a page from that book.
Yeah, and Mark, if I may, I believe at the end of the day, there's just not enough capacity into the market today. And unfortunately, because of that, insurance has become a little bit of a product that custodians like to sell, including, what they have as ratios, et cetera. And it should be, a standard more than a product or a differentiating factor, right? So it's not really protecting the underlying assets or the underlying investors. We do need more capacity into the market. And that's also why you're seeing things like self-insurance, captive pools, et cetera. There's not enough capacity and costs are too high. So we recognize, I think, as an industry, the risk is misunderstood. The modeling is difficult, but as we're getting more data and the industry is continuing to show some level of maturity, I mean, those risks should become more understood. And therefore, we need more capacity into the marketplace, and then we might be able to pivot away from some of these, I'm going to call them exotic products, if I may, but some of the other products we've seen into the market.
Start the industry players there so that we'd have an opportunity for Joseph or Raymond to either agree or rebut their arguments.
Well, I definitely think there's a lack of understanding from market participation on the insurance side. There's no question that is the case, right? I mean, if more markets understood the nature of the risk, there would be more participation and clearer lines of delineation between good risks and bad risks. But I think the other challenge that we all have to openly acknowledge, each custodian is largely providing custody and designing their custody architecture in a way that's different from the next custodian. They may be using a proprietary solution, maybe outsourcing it to an institutional kind of MPC provider. And in every instance, these crime underwriting initiatives are bespoke. And oftentimes, while you can definitely start making generalizations and achieve a little bit of scale from one underwriting initiative to the next, it is still a roll your sleeves up effort with a lot of due diligence in order to put yourself as an underwriter in a position to make an informed decision on one custodian, right? And the degree to which they've eliminated single points of failure, and they've structured an appropriate signing authority and whitelisting processes, and all of these things that go into creating that internal distinction here at Realm between good risk and bad risk. So I think really the challenge is not just to the insurance participation side of things to bring more capacity. It's kind of this joint effort where there's got to be an appetite for these markets to learn and be open to it. But on the custodian and operational side of things, we've got to make sure that you guys are assembling, an underwriting submission that's going to make it as clear and easy as possible for markets to make more informed decisions. I'm not saying that anyone on this call, some of whom we insure, have not made great strides in that direction, but I think if we all collectively understand that there's a lack of understanding or an inability to understand from the capacity provider side of things, the question is then what can be done on the operating side to make that process as painless as possible for everybody.
Yeah, one thing I'll add there is because I think what's one thing that is missing in terms of trying to educate capacity providers in addition to the underwriting activity is just data. And so we, for example, have spent years building a loss event database, so over 1,200 events, really trying to have an outside-in view of not only what has happened historically, but what have trends been over the last 3 months, 6 months, and seeing those can give you again greater insight. Just trying to demonstrate a deeper understanding of the risks, how they're evolving. We think those will all be really essential to get other markets to participate, because end of the day, that will make it be less exotic, to get to your comment, and more of a common type of coverage to seek out and get. And as Joe mentioned, you want to have underwriting that's responsive, and it can't, if it's bespoke every time, you just don't get that efficiency. And so there's again areas where we actually work a lot on the try and build internally.
I just want to comment, because Joe mentioned the underwriting submission. So, I'll also put some of that onto our own industry, onto insurance brokers.
We can't forget the broker's responsibility.
Oh,
Right, Mark. Thank you.
we do have, we do need to help the clients to, I mean, it's incumbent on client, if you want insurance, to be transparent. And that's one of the things we kind of see right away when we start working with a company. Are you really transparent with and realistic with your risks? Often your startup company, it's a great thing for an entrepreneur to be really bought into what they're doing. Are you also realistic with the flip side of it, the risk side of it? And but for the broker to really put together a good presentation for the underwriter is, goes a long way towards helping you guys to differentiate, right?
Great point.
Yeah,
I'll
agreed.
add one more into the mix. What makes this, to add to Joseph's point, what makes it even harder is it is indeed how fast this technology is evolving. And a lot of the times, what ends up happening is the language in existing policies ends up capturing more than what the policy was initially intended to. Or conversely, the insured might get a false representation of what the policy might or might not cover. To make a very simple example over here, I haven't had to deal with it directly. I've been thinking about it because we don't deal with that part of the crypto asset sector. But just taking the example of, say, if I hold private key material that controls some assets locked in some DeFi smart contract somewhere, part of some protocol. That private key material from Fintrac's point of view, the way that they define virtual currency, that means the definition of virtual currency. So I have to consider it asset in my possession, asset under custody, and make it subject to all of the compliance that comes alongside with it. Now, from an insurance point of view, most of the interest in this policies tend to say cryptocurrency, private key material that controls this and that. Are those assets in the DeFi protocol that I keep covered by the policy or not? If the DeFi protocol is to be compromised, there's a hack, there's a smart contract bug, someone takes them out, is that a covered event or not? So these are all open-ended questions and things that I've been thinking about as we've been looking towards eventually maybe doing something in that part of the space. The best idea that I could come up with is maybe working on a scenario by scenario with the underwriters eventually and saying, how about this? How about this? Is this insured? Is this not insured? Is this intent to be captured or not? But,
yeah, and George, that's actually exactly what we're doing. We are seeing smart contract requests for coverage, and again, there is no scale currently, so we are going in and understanding the specific smart contract, understanding of what audits may or may not have been done, and then they're really trying to understand the coverage being sought, and then working with the broker, the insurer, to really understand, is there coverage that we can bring to market. And another item I just wanted to maybe touch on briefly is because I think, Mark, you mentioned the responsibility of the broker. George, to your point around clarity of coverage, we've also believe and worked very hard to make a policy form that is not the most exciting thing to talk about, but to have a policy form that's crypto specific, right? It was built around crypto. We define terminology like hot, warm, and cold. We actually go out of our way to make sure there was a complete clarity and transparency around what is and what is not covered. And in your example around smart contracts, we want to make sure that it's obvious if that is part of coverage or not, and that the coverage is there, because there are two parts of the insurance contract that Joe mentioned.
Yeah, but I think ultimately that idea of smart contract failure, that is a completely separate underwriting initiative, right? And we've gone through these underwriting initiatives and provided smart contract failure, but it's done on a protocol specific basis. It's also heavily predicated on the user profile and the some of those KPIs related to the track record of the protocols to maintain a significant volume of total value locked without significant security instances. So there's no doubt that the prevalence of DeFi over the last 2 years brings with it a host of concerns related to the safe custody of digital assets, but it really is a separate underwriting initiative apart from understanding the security architecture at balance. And that's a challenge, of course.
Great. Okay. I guess I think we have lost Paul along the way, have we? Perhaps his flight took off. So
so it's he needed to make the flight. There's no going, unfortunately.
So I actually was going to ask him for the next question. So we'll whoever wants to answer. But notwithstanding the discussion we've had, and you know, clearly you see from the participants here, there are insurers out there that really understand this space. But in the broad Canadian insurance market, there really is not a lot of insurance available for cryptocurrency. So, I mean, given the strong institutional regulatory demand for insurance, adequate coverage still is hard to come by. Which insurance strategy do you think is most appropriate for digital asset business? You know, and I guess those businesses maybe that don't have enough insurance or finding the cost of insurance prohibitive, self-insurance, forming a captive, working with a third party, some sort of government-backed program. You know, is there an alternative, you know, similar to CDIC for banks that that the industry should be going down?
I mean, maybe Mark, I can start, and others I'm sure will jump in. I think the reality is at this point, all of those options are probably on the table in some way, shape, or form. Specifically in Canada, I mean, if you look at the regulation chain around captive pools, specifically in Alberta, you know, the capacity to the industry to get together to form a captive could be a possibility. Now, I know, Mark, you and I have discussed this directly. There are some risks associated with, you know, starting a captive and basically who you're getting in bed with, for lack of better wording, right? So you need to understand, you know, you need to understand your risk. You need to understand your potential partner's risk. You need to make sure that those risks are somewhat aligned, right? So the businesses need to look pretty similar. But I think all options are on the table. I mean, quite frankly, the cost of maintaining insurance across, you know, insurance for your clients, D&O, E&O, cyber, and everything you need as a custodian. I mean, it can eat up your entire P&L at this point, right? So I think we're all considering all the options, and as an industry, I think we should consider getting together, because we've had other industries that have shown that success in Canada. I mean, you can think about the oil and gas industry as an example. You know, so there's a playbook out there to be put in place, and potentially that's something that the crypto industry needs to focus on a little more.
Yeah, I mean, I think it's a great response there, and 100% alignment on the fact that all options on the table need to be considered, right? Because the one thing we can all agree, whether you're on the operating side or the capacity side or the broking side, right, there's not enough capacity. And if we can't access capacity through traditional insurance market channels, then what other considerations do we have on the table? And Didier, the commentary around group captives is spot on, right? Conceptually, they make so much sense, but the idea of everybody working together and being comfortable with the level of group interaction is more challenging in reality than it is on paper. And so, but certainly that needs to be something that is a continual conversation that's happening within, you know, you and your peers in the market that actually have an appetite to work together in that fashion. But I think if you take a step back and zoom out and look outside the digital asset industry, and you are aware that 90% Fortune 1000 companies have utilized captive insurance or reinsurance within their holding company structure in one form or another, right? This is not a novel concept. This is literally the go-to solution for companies that are sophisticated, for companies that have access to capital, and for companies that want to put themselves in a position to strategically retain underwriting profit and or create capacity for risks that are not well understood or accommodated by the insurance marketplace. And, you know, part of the whole proposition, I think, in philosophy that we've had about the space is, how can we provide a solution that can combine traditional elements of risk transfer along with alternative aspects of risk financing and risk transfer solutions through the use of captive insurance facilities? And whether those captives are set up on kind of a pure captive basis directly for the benefit of the operating affiliate, or something that can merge or evolve into a more group or industry type solution, you've got to start somewhere, right? So I think really what needs to happen is some of the players within Canada, I know some have already, need to actually move the needle on their own to put some of their capital to work in a regulated, transparent, sell or standalone captive insurance facility and demonstrate it is a viable strategy. It's ring fencing assets for the sole purpose of protecting the insurers. And if one or two or three or four of you can make a step in that direction, it makes the link to the group or the industry, I think, a lot more tangible and viable.
Yeah, I think that's right. I think that it can be, a handful of players who see the need, the value. I think the challenge, while they're, I think ultimately it's the industry maturity that's the challenge. I mean, there's so much still developing. I think that's a bit of the obstacle. Having been involved in a couple of these discussions, I think it's just really challenging to get, some of these smaller firms to really come together and recognize the value and dedicate not only just financially to make commitments, but just in terms of time, right? Just the amount of time of people and resources to commit to it. But I think there needs to be a wide set of solutions in the market. I think that's quite clear.
Great. I'll remind the audience before we ask another question, there is a Q&A box, I guess, to click on. If you have any questions, feel free to post them. I was curious to maybe throw it out there that, because Gallagher works with digital assets globally, so we see kind of the availability of coverage in various countries. There are not really domestic Canadian options other than, say, through Lloyd's to speak of. There are some. I have a colleague in the U.S. that actually is in the audience today, who has domestic options in the U.S. that will provide coverage. So, and in many countries, I find it's actually easier to find insurance coverage than it is in Canada. I was wondering, given the regulatory environment in Canada and given, kind of the position of Canadian companies, I wanted, kind of George and Didier, your thoughts on that, and whether that's, what can you as an industry do to encourage insurers to jump in?
If I, forgive me if I'm doing a quick turnaround, but I actually have a curiosity for you, Mark. With regards, and it's on the same topic, with regards to the lack of available insurance in Canada, putting aside the bespoke policies, the vault risk, crypto crime, cyber security, I understand those require quite a healthy amount of time and energy and mental stamina to go through understanding the security architecture of those platform operators, to understand the risk profiles of the smart contracts that you might or might not want to insure. Maybe Joseph or Raymond have the appetite and the interest for it, but it might be complicated for some Canadian local underwriter to get into those. But I'm still very surprised that in 2022, we don't have good D&O, for example, which is, you would expect that the risk assessment framework with regards to how do you determine whether an executive is misrepresenting at every step in his fit of character to run that particular business or not, that would be well understood and established. Is it branding risk? Is it the lack of, the lack of growth in the market to some degree? Like, why are local Canadian underwriters still not doing that in this day and age?
Well, yeah, and I mean, there's a certain number of large insurers that just have an absolute no for cryptocurrency, right? And so that's one of the pieces, one of the challenges of kind of, proving that the industry is an acceptable risk for them to take on. I guess some of the interesting things when we're working with clients, it can't, we can get you crime cover, we can get you directors and officers covered, and I do understand why there's a challenge in underwriting these. We do face the same challenges though when we're getting you commercial general liability or property coverage for your facility. And really what you're doing shouldn't be more challenging to me than software as a service, right? Commercial general liability is more or less, tort. So like things like people slipping and falling in your facilities. And so it's kind of, I'm not answering the question. I'm more kind of, I'm baffled why it's so difficult to find coverage for.
Yeah, I guess, Mark, I was actually going to kind of challenge you on that to actually see if you can give us a direct response on why the local Canadian markets, don't have the appetite for traditional insurance products for companies operating in new and innovative spaces. I mean, is there a solid response that you're kind of consistently getting from any of the local Canadian markets?
The solid response I generally get from Canadian markets is no. And not to be flippant with the answer, but and sometimes it's, you know, some Canadian insurers are subsidiaries of US companies, so it's just a directive from head office. But it's
Yeah.
you know, and this is my challenge to the industry, that I guess you know, if there's if you can prove that you're better regulated than other areas of the world, you know, perhaps you should be the place for insurers to experiment with this industry.
Yeah, I think the other challenge is too, you know, if you actually look at the insurers that make up any local admitted market, right? These are insurance companies that have been around for a long time. They're underwriting traditional insurance for traditional industry sectors. And there's tons of loss data that they're exercising in order to put themselves in a position to stand up in front of their risk committee and reinsurance committee and ethics committee to confidently project future frequency and severity of loss. And if you take the buckets of premium that they're generating from risk that is totally compliant, traditional, with the historical loss experience, and then you look at the comparatively small amount of premium that they might be able to generate by supporting an industry that's got question marks everywhere, regulatory, you know, ethics, fraud, all of these other things, it becomes a very difficult proposition internally and bureaucratically for larger established markets to get management commitment on a top level down to start supporting something that could pollute their entire business model if you look at it from a worst case scenario standpoint. So I think, I don't know, Mark, I mean, you're on the front lines, obviously we're not, but that to me seems to be one of the reasons in any country why some of the local markets just are electing to not participate right now.
I think that's a great answer, and I think education is a key thing for helping them to get there. And this is something that I guess the you know, Canadian Blockchain Consortium is here for, and that's one of the things
Great cause
to continue doing.
I think Joseph, if I may, I mean, have to be careful. There's probably some regulators on the call, and I think Canadian regulators overall have done a great job, you know, with some of the events that we've had in Canada and dictating, you know, at least policy and regulation from a CTP perspective. But we still have federal regulators that would be overseeing some of these big insurance companies in the country that are applying a punitive framework to this asset class still, right? Now, the good news is they have basically said, you know, we need to have a consultation with the industry, you know, and those would be held in 2023, 2024. And there's a roadmap as to, you know, how things may change. And you know, it's always great to see a regulator say, please come to the table. We want to hear about the industry. We want to hear about what's going on. We want to, you know, we want to form policy around it. But I think it might be, to your point around, you know, polluting your book of business or the top-down approach of support. I mean, if you're having a very senior federal regulator saying, don't touch this asset class, if you're regulated by us, nobody will, right? So, and I think unfortunately in Canada, we're still seeing that a little bit.
Yeah. And I think, and I completely agree with you. And my commentary really was kind of for local admitted markets, really in any country. But I would agree with you that on the regulatory front in Canada, there are clearer lines in Canada than there are in any other or in many other jurisdictions. So this is the challenge of being first, right? For you guys coming up and pioneering amazing products and technology that really is going to serve a greater good. But you've got to have the appetite and mentality that the picks and shovels that are really going to continue to prop up your industry on a go-forward basis are still being manufactured and formed. And it really comes down to creativity, resiliency, and best practices to do everything that you guys can on the operational side to, you know, continue doing what you're doing, which I think is great and a credit to you for sure.
There's a comment in the question and answer, and I think this partially answers part of the struggle for the insurance too. Is so there's been significant uptake in the Caribbean for setting up crypto companies. However, for regular P&C insurance, reinsurance capacity is already a huge issue. So having said that, how can existing insurance companies expand to crypto insurance? And I guess the question there is, well, how can they you know, if they would have to have a way of getting reinsurance capacity to it.
Yes. I mean, you're right. I mean, one of the interesting things is when you're speaking with underwriters at other companies that have a great balance sheet and have an AM Best rating and have a global presence, you're speaking to some of these underwriters that are genuinely interested in the industry. They want to find solutions, but that prohibition isn't necessarily even coming from management. It's coming from the reinsurance treaties that support the rest of their book of business. And you're right, Mark. I mean, the challenges that Didier and George are facing getting primary insurance are ironically the same challenges we're finding getting reinsurance, right? And that puts us in a position where we have to be very careful about our limit deployment on a per contract basis. And as much as we'd love to provide custodian A with a lot of limits of insurance, the lack of availability of a risk transfer solution for Realm as a direct writer of coverage is going to kind of curb our enthusiasm, in all instances in that regard.
So maybe with that, we've covered a lot of big topics here. Are there any other challenges or opportunities? And I'll ask kind of broadly if anyone has anything they want to bring up on this. Other challenges or opportunities you see with respect to insurance in the crypto and digital asset space? I think the reinsurance was actually a great challenge that that you've just brought up. But
yeah, I would say just on that topic too. So we set up the first collateralized insurance facility in Bermuda earlier this year that can accept both fiat and digital assets as regulated collateral, right? So if you go back to the point that George was making, which I think is a great point, is the ideal way to provide custody or theft-related insurance of digital assets is to actually nominate that policy in the currency that's being protected, right? So if you take Bitcoin as an example, if there's a theft of a custodian's client's Bitcoin, that client really is going to want that to be made whole again in BTC, not CAD or USD. So I think an opportunity, certainly a challenge, is to really look at policy limits and come up with a solution where those limits are denominated in a currency that may make a lot more sense from an exposure standpoint and will create a better mechanism for protection and resilience in the industry.
I guess to make an overarching comment, there does, and it's very unfortunate because especially with what's been happening with FTX, like we're not getting much credit and benefit there. There is a need for a significant shift top down from some of the, let's call them old guard at the various institutions with respect to the asset class itself. Like we've been treated since 2017 like we come from the radioactive part of heaven, and eventually we hope that will change. It will still take time. Like just to make an anecdote here, a close friend of mine went yesterday night and met Stephen Poloz, one of the former governors of Bank of Canada at a local event, got his autograph on his book, The Next Stage of Uncertainty, and obviously knowing that he's in the crypto industry, he just writes on it, Bitcoin is going to zero. And like as the dedication, what a signature, right? We're keeping it as an artifact. Eventually, it will make for some giggles down the line. The way I look at it, the digital transformation that's been happening over the last 15-20 years brought us digital communications, digital access to information, digital infrastructure, digital media, all sorts of type of entertainment, from music, video games to movies. To say that digital money isn't going to be it and won't bring any benefits to society and to the world as a whole is an intellectually lazy position in my view. So I hope some of this message maybe comes across, and I will keep repeating it wherever I go, and some of the older folks will start getting a bit more educated about the asset class and understand that even though this industry looks a little bit like a tale of two cities, you have all the fraudsters and scammers that are trying to operate off of offshore boats, and those will still be there until you have those strong regulatory frameworks in place. You do have a part of a space that's been building slowly, managing risk along the way, trying to build something for the long run, and really, putting their best foot forward and trying to contribute to the financial infrastructure of the next generation.
Yeah, one thing I could add is, as you were speaking, George, you reminded me that, I think in general, there's a need for innovation. Like you guys are innovating truly from a financial services product point of view. There's a need for innovation from within insurance. And, Joe touched on one of them being just the need for the crypto denominated carriers. You could think about DeFi or smart contract type insurance that really starts to really challenge and rethink how insurance as a product is administered. I would say, and this is just perhaps the audience in general, the real challenge is around people. So, think about the type of people who actually understand your businesses, both technically as well as sort of how you're going to market and the product sets. It's quite small. And, those people do not want to work in insurance. I mean, let's just be honest, right? And so, that's something that we certainly see. And we've been lucky in terms of people who we've attracted because of the role we think insurance can play in a market. But that fundamentally is an issue, while it's a small market today, we think it's going to be growing and growing massively, digital assets. So the question for the insurance industry is how do you attract the right people who can actually understand the risk and then also innovate on the product side to make these be less of an exotic experience, as Didier mentioned.
Well, we're grateful both you and Joseph are here in the space and on the call.
Yeah, trying our best.
Raymond, are you saying that we need to make insurance great again?
Yeah, I'll get a hat made, Joe.
Please don't. But Mark, I think it's been a great discussion. I think the last 4 weeks there's been so much time spent talking about all the negativity in the space and all unfortunate set of circumstances that have led to kind of an extension of this kind of crypto market malaise. But the reality is there are legitimate players in the space that are on this phone call that are spending a tremendous amount of money and expending a ton of resources to structure their companies in a way that is going to provide products and services for the good of their customers and the industry, and they're building companies for longevity. So I think it's a great opportunity to also recognize that there are a ton of great things that are happening in the space, leveraging technology that's going to impact not just financial services, but healthcare and real estate development. And I think 10 years from now, looking back on these conversations, we're going to kind of chuckle at some of these basic fundamental challenges that we are absolutely going to be taking for granted down the road. Difficulty of securing a bank account, getting D&O insurance. It's going to come with time. And I think we just need to be patient and dedicated toward, moving our respective efforts forward.
Great. Well, thank you very much, everyone. I think it's been a great discussion, and there's much more discussion still to be done. But we are getting there. For those who are in the audience that feel like there isn't insurance available, there is insurance. They're not saying that it's cheap. It can be costly, but it's it is an evolution over time.
Great. Thank you, Mark.
Yeah, thank you for having us. Thanks for hosting, Mark, and to the CBC.
Yeah.
Yes, and thank you very much to the CBC for allowing us to have this session.
Wonderful. Thank you guys so much for being here today. It was an amazing conversation. I know I learned a lot. I hope all of you listening enjoyed the webinar. It'll be available on our YouTube channel by tomorrow. Thank you.
Fantastic.
Thanks, everyone. Thank you. Bye.
Bye.